insurance. Thank you so much for joining me in this video about equity index annuities versus stocks, bonds, mutual funds, or bank certificates. This video is geared towards people who are tired of losing money on stocks and mutual funds, people who are tired of low CDs, IRAs, and money markets, for people who are stuck in low interest rate annuities, and people who would really like to have higher returns with guarantees. When comparing an equity index annuity certificate to other investments, you want answers to a few important questions. To start off, what is an equity index annuity certificate? And basically, it's a lump sum of money with an insurance company. Equity index annuities were introduced in 1995 and have gained popularity ever since. The principle behind equity index annuities is the ability to participate in an equity-linked interest rate while avoiding the downside risk associated with the market. Equity index annuities have a traditional guaranteed minimum interest rate with an excess interest feature that is linked to an index. Two examples of an index would be the S&P 500 or NASDAQ 100. Here's a brief look at these two indexes. The NASDAQ 100 was launched in 1985. The NASDAQ 100 index includes 100 of NASDAQ stock market's most actively traded issues. Its 100 companies are selected for the largest domestic and international non-financial companies listed on the NASDAQ stock market. Some of the household names include Microsoft, Yahoo, Dell Computers, Starbucks, Northwest Airlines, and more. Standard & Poor's 500 index represents a broad cross-section of common stock traded on the New York Stock Exchange, the American Stock Exchange, and the NASDAQ National Market System. The index is a selection of 500 leading companies found in leading American industrial market sectors. One of the biggest questions we all ask is, how fast will my money grow? The fact is, it will usually grow faster in an equity indexed annuity. And the reason for this is because your interest earnings are tax deferred. This means you get to keep the money you would otherwise send to the IRS. Here's an example of how this tax deferral works. One investment, we invest $100,000 at a 6% interest rate. And we are at a 35% tax bracket. In 10 years, our money grows to $146,607. And in 20 years, our money grows to $214,937. With an indexed annuity certificate, we invest the same amount of money, $100,000, at again the same 6% interest rate. The difference is we are deferring our taxes. In 10 years, our money grows to $179,085, and in 20 years, it grows to $320,714. So a major difference there. And again, this is because of deferring taxes. The fact is, with other investments, they cannot give you triple compounding. And basically what that means is, with an annuity, you get interest on your principal, interest on interest, or your earnings, and you also earn your interest on your tax savings. Another thing you need to keep in mind too with other investments, those earnings can affect or reduce your Social Security benefits. So very important for retirees. Another great thing about the indexed annuities is that you can pass it on to your heirs probate free. It works just like a will. You set up your annuity contract and you set up who your beneficiaries will be. So in the event when you do pass on, you have your beneficiaries listed and it just passes right over to them. And without skipping a beat, it doesn't get held up by lawyers or courts or probate or anything. It just seamlessly moves right over to your loved ones. Let's take a look at three components of an equity index annuity. The first one would be the participation rate, and that is a percentage amount which is multiplied by the percentage gain of the index formula, measuring the percentage increase in the index that is credited to the account value. The participation rate may or may not be guaranteed, either by the year or for the policy index term. An annual asset fee, sometimes referred to as a yield spread or margin cost. An annual asset fee is a flat percentage deduction from the index growth calculation, deducted deducting an annual asset fee has an effect similar to offering a participation rate lower than 100%. A cap is a maximum percentage limitation on the product's earnings as defined in the equity index annuity formula. One of the biggest things people are concerned with is safety. Insurance companies are safe and guaranteed. This is probably one of the most regulated types of industries in the world. First, it's regulated by the state insurance departments. Insurance companies must keep minimum capital and surplus requirements. Third, they also have to have a 100% minimum reserve required by law, and they have to file annual statements. They also need to do statutory accounting. There's also investment restrictions, and they also have what's called the guarantee fund. And what the guarantee fund is, it's very similar to the FDIC. The fact is, equity index annuities are safe, guaranteed by the reserves. They have billions of assets by the world's largest life insurance companies. And again, the advantages are you get non-qualified funds get tax deferral. There are no renewable surrender charges. And with named beneficiaries, you avoid probate. And you get a free annual withdrawal provision. You have life income guarantees. And usually, the annuity interest rates are usually higher than bank rates. As you can see, when you become familiar with the facts, it makes a lot of sense to trust an insurance company. The nice thing about annuities versus other types of investments is there are no loads, there are no fees, there are no sales charges, there's no market risk, and there's no tax during the accumulation period. Again, that's the tax deferral. There's no charge against Social Security, there's no lack of safety, and there's no lack of liquidity. So basically, really, there is no excuse to not invest in an equity index annuity. Here's just a quick quote from the Assistant Secretary of the U.S. Treasury. He says, "From the standpoint of the contract holder, a deferred annuity during its accumulation period does not significantly differ from the long-term certificate of deposit, which incidentally also may be subject to penalty if it is surrendered prematurely, or any other portfolio investment which may be reduced to cash at any time. Nevertheless, interest from other portfolio investments is taxed currently, whereas earnings credited to a deferred annuity are not. To the extent that annuities can be fashioned to offer interest rates that are competitive with rates paid by other financial instruments, there is little reason why a potential investor should purchase anything but a deferred annuity." Again, these are great words from the Assistant Secretary of the U.S. Treasury. To sum it all up, which location do you want your money in? Location 1, a taxable investment with risk, where you would lose 1 out of each 3 years' interest earnings to taxes, or Location 2, a tax-deferred equity index annuity, where you do not have any risk, and you decide when you pay the taxes. So you can see, any prudent person who have reviewed all the facts would see that an equity index annuity would be a very wise investment choice. Not only are you getting very competitive interest rates, but you're also getting that tax deferral, and that is just huge because you get to save all that money, build interest even on that, and then at the end of the day, when you're actually ready to use that income, that is when you're taxed on it. Plus, you get all the other advantages we discussed with having the investment be probate free. You also have income, guaranteed income for your life, and a lot of other fantastic benefits.